Hey everyone, welcome back to Corporate Decoder, the place where we break down the nitty-gritty of financial reports so you don't have to. And let me tell you, this report has some interesting swings and roundabouts, almost like a company trying to find its footing in the digital age. Today we are diving deep into YXTCOM Group Holding Limited's interim report. We're going to sift through the numbers for the 6 months ending the 30th of June 2025 and see what story they tell about this company's health and direction. If you love getting these kinds of no-nonsense financial breakdowns, make sure you are subscribed and hit that notification bell. And hey, we've got a growing community over on Discord where we chat about these things more. Link is in the description below, so come join us. Alright, let's get straight into it. YXTCOM Group Holding Limited filed a Form 6K, which is essentially a report of foreign private issuers, giving us a look at their performance. The big picture here is their financial condition and results of operations for the first half of 2025 compared to the same period in 2024. First off, let's look at how the company is managing its customers. As of the 30th of June 2025, they had 2,358 subscription customers. That is down from 2,481 in 2024. Now that might sound like bad news, but the company explains this is a strategic move. They are focusing on larger enterprise clients who have a more consistent need for corporate learning. This means they're shedding smaller customers who might churn more easily. Their net revenue retention rate, which basically means how much revenue they keep from existing customers, dipped slightly to 100.3% from 102.8%. So, while they have fewer customers, the existing ones are still spending, which is a decent sign for their core business model. Now for the numbers that really matter, the financials. For the 6 months ended the 30th of June 2025, total revenues were 152,894,000 RMB, or about 21.3 million US dollars. This is a decrease from 165,756,000 RMB in the same period of 2024. The bulk of their revenue comes from corporate learning solutions, which was 152,417,000 RMB in 2025, down from 164,420,000 RMB in 2024. Breaking this down further, subscription-based corporate learning solutions brought in 144,740,000 RMB in 2025, down from 151,834,000 RMB in 2024. The company attributes this to operational adjustments like suspending some online teaching tools and that strategic shift to larger clients, which naturally means losing some smaller ones. They also mention the deconsolidation of a company called Seebs PG, which further reduced revenues by 2.4 million RMB. Non-subscription based solutions, which includes things like offline offerings, saw a bigger drop from 12,586,000 RMB in 2024 to 7,677,000 RMB in 2025. This also aligns with their strategy to focus more on digitized subscription-based learning. And then there are others, which includes custom software and maintenance. This also decreased significantly from 1,336,000 RMB to just 477,000 RMB, again due to their new strategic focus and fewer custom projects. Let's look at the cost to generate that revenue. The cost of revenues for the first half of 2025 was 53,380,000 RMB, a nice drop from 64,419,000 RMB in 2024. This is a 17.1% decrease. They say this is thanks to more efficient operations using AI tools and optimized staff and infrastructure costs. Lower instructor costs also play a role because they are reducing offline solutions. This efficiency in costs led to a gross profit of 99,514,000 RMB, or about 13.9 million US dollars for the first half of 2025. That's only a slight decrease from 101,337,000 RMB in 2024. But here is the kicker, the gross margin actually improved to 65.1% from 61.1%. This is a solid improvement, showing they are becoming more profitable on the revenue they do generate, thanks to that focus on higher margin solutions and cost savings. Moving on to how they spend money to make money. Sales and marketing expenses were 61,932,000 RMB in 2025, down from 71,569,000 RMB in 2024. That is a 13.5% decrease. They claim improved productivity with AI tools and branding campaigns are helping them acquire, convert, and retain customers more efficiently. Also, fewer sales and marketing staff contributed to this decrease. Research and development expenses also saw a decrease, falling to 48,277,000 RMB in 2025 from 59,772,000 RMB in 2024. That's a 19.2% reduction. They are attributing this to better research and development return on investment, thanks to a new approach to product market fit. And again, optimizing their human resources in this department. Now, here is an interesting point. General and administrative expenses actually went up from 45,000 RMB in 2024 to 54,219,000 RMB in 2025. That's a 20.4% increase. This rise is mainly due to higher professional service fees and an increase in share-based compensation for administrative staff from a new incentive plan. However, they did see a decrease in staff compensation, and the deconsolidation of SEEB's PG offset some of these increases. And finally, the bottom line, the company reported a net loss of 73,878,000 RMB, or about 10.3 million US dollars for the 6 month ended the 30th of June 2025. This is a significant swing from a net income of 21,359,000 RMB in the same period of 2024. A substantial loss here. They also provide a non-GAAP measure, adjusted loss before income taxes, which was 64,000 and 5,000 RMB in 2025, compared to a loss of 75,316,000 RMB in 2024. This adjusted loss, after removing certain items like gains from deconsolidation and changes in fair value of derivatives, gives a slightly different picture of their operating performance, but it is still a loss. Let's talk about liquidity. As of the 30th of June 2025, the company had 142,590,000 RMB, or about 19.9 million US dollars, in cash and cash equivalents. This is a decrease from 418,242,000 RMB in 2024. They have a lot of their cash held in China, with about 8.4 million US dollars in renminbi and 11.5 million US dollars in US dollars. Looking at cash flow, they used 94,868,000 RMB in operating activities for the first 6 months of 2025. This is down slightly from 101,533,000 RMB used in 2024. The difference between their net loss and cash used in operations is mostly due to things like a decrease in deferred revenue, which means they received cash for services not yet rendered and an increase in other payables. But on the flip side, things like share-based compensation and impairments of investments used up cash. In investing activities, they used 94,720,000 RMB in 2025, mainly for short-term investments and purchasing equity securities. This is a big jump from the 33,777,000 RMB used in 2024. Financing activities showed a net cash outflow of 85,718,000 RMB in 2025. This was driven by repaying long-term and short-term borrowings. In contrast, 2024 saw a net cash inflow of 86,511,000 RMB from financing primarily from new long-term and short-term borrowings. This indicates they are paying down debt rather than taking on new debt in 2025. Looking at their commitments, they have significant obligations with 27,323,000 RMB for operating lease commitments and substantial amounts for short-term and long-term borrowings. They have over 70 million RMB in short-term borrowings due within a year. Capital expenditures were very low for the first half of 2025, just 26,000 RMB, down from 1.0 million RMB in 2024. This suggests they are not investing heavily in new assets like equipment right now. Now, let's touch on market risks. They mention concentration of credit risk, but their cash and investments are with high-quality institutions. Foreign currency exchange rate risk is also a factor, with the RMB depreciating about 1.86% against the US dollar in the first half of 2025. This can impact the value of their US dollar holdings when converted back to RMB. So, what is my take on all this? YXTCOM Group Holding Limited is clearly in a transitional phase. The strategic shift to focus on larger enterprise clients and digitized solutions is evident in the numbers. They are improving their gross margins, which is a strength, and cutting down on sales and R&D expenses, potentially to streamline operations. However, the shift is also leading to fewer customers overall and a significant net loss for the period. Their increased administrative expenses and rising debt repayment show that while they are becoming more efficient in some areas, other costs are creeping up. The reliance on debt financing with a substantial portion due within a year also presents a risk. The company is banking on this new strategy to drive future growth, but they are facing financial challenges in the short term with a considerable net loss and a decrease in overall revenue. The opportunities lie in successfully capturing and retaining those large enterprise clients, while the risks are around their ability to manage their debt obligations and generate positive cash flow from operations in the face of these large strategic changes. It is a bold move, but the execution will be key to whether this transitional period leads to sustained profitability or continued struggles. Alright, that is our breakdown of YXTCOM Group Holding Limited's latest interim report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.